This is a story about one of the largest corporate bankruptcies in U.S. history. It all begins in the late 90s. Enron was the darling of Wall Street, a shining example of corporate success and innovation. The company's meteoric rise to the top of the energy industry seemed unstoppable, fueled by a combination of aggressive expansion, strategic partnerships, and a culture of risk-taking that set it apart from its competitors. Led by CEO Jeffrey Skilling and Chairman Kenneth Lay, Enron was hailed as a visionary company that was reshaping the energy industry through its innovative trading strategies and financial engineering. The company's stock price soared to unprecedented heights, making it one of the most valuable companies in the world. However, behind the facade of success, a darker truth was lurking. Enron's rapid growth was built on a foundation of deception, with executives using complex financial transactions, off-balance sheet entities, and aggressive accounting practices to mask the company's true financial health. In addition to CFO Andrew Fastow, a major player in the Enron scandal was Enron's accounting firm, Arthur Andersen LLP, and partner David B. Duncan. As one of the 5 largest accounting firms in the United States at the time, Andersen had a reputation for high standards and quality risk management. Despite Enron's poor accounting practices, Arthur Andersen approved Enron's corporate reports. By April 2001, many analysts questioned Enron's earnings and transparency. In August 2001, Skilling resigned as CEO, citing personal reasons. Around the same time, analysts began to downgrade their rating for Enron's stock, and the stock descended to a 52-week low of $39.95. By October 16, the company reported its first quarterly loss and closed its Raptor SPV. SPV, or Special Purpose Vehicle, is a subsidiary company that is formed to undertake a specific business purpose or activity. This action caught the attention of the SEC. A few days later, Enron changed pension plan administrators, essentially forbidding employees from selling their shares for at least 30 days. Shortly after, the SEC announced it was investigating Enron and the SPVs created by Fastow. Fastow was fired from the company that day. The company also restated earnings back to 1997. Enron had losses of $591 million and $690 million in debt by the end of 2000. Dynegy, a company that previously announced it would merge with Enron, backed out of the deal on November 28. By December 2, 2001, Enron filed for bankruptcy. Skilling concealed the financial losses of the trading business and other operations using MTM, or mark-to-market accounting. This technique evaluates the value of a security based on its current market value rather than its book value. Enron employed a strategy where it would construct an asset, like a power plant, and immediately record the projected profit on its books, regardless of actual returns. If the revenue fell short of projections, the company would transfer the asset to an off-the-books entity instead of acknowledging the loss, keeping it unreported. This method allowed Enron to write off unprofitable ventures without impacting its apparent profitability. To manage the increasing liabilities, Andrew Fastow, who served as chief financial officer in 1998, devised a deliberate plan to portray Enron as financially healthy despite losses incurred by many subsidiaries. Enron was internally creating false financial records and inflating the company's profitability before it was discovered. Even though the organization was successful operationally in the 90s, the company's wrongdoings were eventually made public in 2001. Before the year 2000 began, Enron's operations seemed to be doing well. Just a few months before 2000, the business introduced Enron Online, a trading website that allowed for better contract management, making it the largest natural gas provider in North America by that year. For the most part of the 90s, Enron's stock price tracked that of the S&P 500. On the other hand, the company's expectations skyrocketed. The shares of the corporation rose by 56% in '99. It rose by an additional 87% in 2000. The company quickly traded at a 70x price-earnings ratio as both returns significantly outpaced those of the overall market. Then after a while there were some signs of trouble. But before I tell you that, be sure to like and subscribe if you are enjoying this video. I'll give you 5 seconds. You did it? Now we can continue. Enron Broadband revealed enormous losses in August 2001. When the company released its Q2 2001 earnings report, Lay stated, "In contrast to our extremely strong energy results, this was a difficult quarter in our broadband businesses." The Department of Broadband Services declared a $102 million loss for this quarter. Additionally, around this same period, Lay predicted far higher stock values and sold 93,000 shares of Enron stock for about $2 million. all the while encouraging staff members to keep purchasing the stock by email. Ultimately, it was discovered that Lay had sold more than 350,000 Enron shares for a total gain of more than $20 million. A woman called Sharon Watkins had voiced concerns about Enron's accounting procedures during this period. She expressed her worries in an anonymous letter to Lay as an Enron vice president. When Watkins and Lay finally got together to talk about the issues, Watkins gave Lay a 6-page report outlining her worries. Together with Enron's accounting company, an outside legal firm was consulted about the allegations, and both concluded that no problems could be identified. Enron announced a $618 million third-quarter deficit by October 2001. Enron declared that in order to fix accounting irregularities, its financial statements for the years 1997 through 2000 would need to be restated. At the time, Enron's $63 billion bankruptcy was the largest on record. Enron's road to bankruptcy was essentially sealed on November 28, 2001, when credit rating agencies downgraded the company to junk status. Enron was trying to merge with Dynegy, another energy business, but on the same day, Dynegy decided to end any future talks and reject any merger agreement. At the close of business, Enron's shares were worth just 61 cents. Following its 2004 bankruptcy filing, the newly elected board of directors filed lawsuits against 11 financial institutions for their role in covering up Enron leaders' dishonest business activities. As part of settlement agreements with these financial institutions, Enron obtained around $7 billion. Among the banks were Citigroup, Deutsche Bank, and the Royal Bank of Scotland. A not guilty plea was entered by Lay to 11 criminal charges. He faced a potential sentence of 45 years in jail after being found guilty on 6 counts of wire fraud and securities. But Lay passed away on July 5, 2006, just before his sentencing was scheduled. Along with additional allegations of insider trading, Jeff Skilling was found guilty on 19 of the 28 counts of securities fraud. Despite an agreement struck with Skilling in 2013, he was given a sentence of 24 years and 4 months in jail. His sentence was reduced by 10 years as a result of the agreement. The Enron scandal sent shockwaves through the financial world, exposing systemic failures in corporate governance, accounting practices, and regulatory oversight. It was a wake-up call for the entire industry, prompting a re-evaluation of corporate ethics and accountability. The rise and fall of Enron remains one of the most infamous corporate scandals in history, serving as a cautionary tale for businesses and investors alike. It highlights the dangers of unchecked ambition, unethical behavior, and a lack of transparency in financial reporting. Thank you so much for watching until the end. Be sure to like and subscribe for more videos like this.